Good morning, everybody, and welcome to another episode of Therapy Shorts for That. We are your hosts. My name is Nate Brown.
And I'm Edwin Moreno, and today we're going to be talking about a few different tax-free vehicles that, if you don't know about, you're definitely going to learn about. And if you do know about, I think you'll learn some more because, Nate is, I'll say he's an expert in this field, and this is what he focuses on. And he's about to bless y'all with some information on these different types of tax-free vehicles, which, yeah, man, you've hit me, especially last time you talked about, if you haven't heard the episode or seen the episode, Nate, you talked about IULs. You really went deep into IUL as a tax-free, as a way to, put money away tax-free, um, retirement money potentially away tax-free. And I was blown away with some of the stuff that you shared, all the gems that you shared. So if you haven't seen that episode, go check out that episode. I believe it's episode 15, if I'm not mistaken.
Maybe.
Um,
Yeah, 15 maybe. Yeah, I think you're right.
yeah, I believe it's episode 15, 14 and 15, but it's one of those episodes, and Nate really breaks down IUL, the different kinds of just options that you get, and yeah, very, very eye-opening. But I guess there's more, Nate. So there's more.
More.
There's more. So can you, like
There's
what
more.
what are you thinking? What are these tax-free
I
vehicles that
mean,
that come to mind?
there's the two main players in the tax-free world are the IUL and the Roth account. It can be a Roth plain, a traditional Roth. It could be a 401k Roth. Like a lot of people are like, what's the difference of all these things? So most people, because it's an employee-based system, they all are familiar with the 401k. 401k, 401k, 401k. A lot of people don't really talk to a financial advisor about what to do with their finances until they're high into the 60s or approaching retirement years. At that point, it's not wise to do the IUL. So they're like, man, IUL would have been perfect if I was 30 and I just found out about it because then I have, time and compound interest. You got to have the two. Compound interest is great, but if you only got a year to compound, I mean, compared to 20, 30 years of compounding, whoa. So a lot of people are in a situation where I've been working for this company for 10 years and I worked for this company for 15 years and I have 60,000 in this 401k and I got 120,000 in this 401k, and by the time they're about to retire, yeah, my 401ks have grown to $500,000. Yeah. And then they wake up to reality and say, I'm about to give Uncle Sam half my money when I retire.
Oh, because you got to pay
Ouch.
tax.
They
Oh,
gotta
so
pay
hold on a second.
taxes.
So what's the diff? All right. So really quick for our viewers, because you mentioned something. So you mentioned some of these two tax-free, vehicles that can be used.
Hmm.
But there's a lot of people that just have 401k. Like that's what we know of is 401k. So could you like just, for me, for the listeners, for the viewers, what's the difference between a 401k and a IUL?
Okay. Let's break down the differences between the two. So your 401k, people love it because you get a smidget of free money, usually about 3% or something. Your employer may match you dollar for dollar or something. So you get money that you get to put away in the market, which is cool. And they get to match it by a little bit. It's a tax write-off for them for the company. For you, it could be some free money. It could grow to be a tax bomb, depending on if you're wise or not. But it's free money. Everybody likes free, especially free money. So 401k, you do have the option to get some free money. But here's the problem with it. Your money is tied directly to the market. So you're going to have market spikes and you're going to have market downfalls. So you're pretty much gambling with how's the market going to perform with my money. So that's one difference. With the 401k, you're directly tied to the market. With the IUL, you are indirectly tied to the market, which means you have market participation, but only of the gains. And if the markets go down, you have a floor. So one difference is, let's say the markets shoot up 20% in your 401k. Yay, I'm happy. I get to participate in this 20%. In an IUL, you might be capped at 15%. You're like, yeah, I got 15%, but I didn't get the full 20%. Man. But the next year, the market tanks and it goes down negative 20%. You're like, man, my 401k sucks. If I'm supposed to retire this year, I'm pissed off. However, if you're an IUL, you have a floor. You don't participate in the market downside. So you're like, okay, my money's right where it was at last year. I'm good. So that's one difference of just the way that it performs in the market. Second difference is when you start to take out your 401k after 59 and a half for your retirement years, you have to pay taxes on all those gains. So all that money that's been accumulating, a lot of people are like, I'm ready to take withdrawals out every year or something like that. Cool, but you do now have to pay Uncle Sam on the harvest and not the seed. So if you grew it up to $100,000 and you want to take that out as your income now, you have to pay a $100,000 variation of taxes. If you grew it to 700,000, you're going to be smacked with that 32%. So it's like, ooh. However, in the IUL, if you systematically take out your money as a policy loan, you fall under an IRS code 7702, I'm sorry, dash A, which says you don't have to pay taxes on this money. So you can
So
structure,
you have a law, so just so you have a law protecting you with this IUL,
you do.
where like the law that's protecting you is, hey, you took this out as a loan, you don't got to pay taxes on this. But there's also like the risk, right, that you take. Like that, I mean, that's why there's a law to it, because it's like if you're taking money out, you might like the cash value, like you might be messing with like some of the stuff that like has built up, but nonetheless, it's your money. You can do what you want with it. And in a 401k, what you're telling me is if I wanna take money out of that, I gotta pay a tax no matter what. Even if it's a loan, even if it's like there's no matter what, I gotta pay taxes on what I'm taking
Yeah.
out.
You got to pay taxes on it and you have an age clause. So if life starts life in at 55 and you need that money right now, you're going to get hit twice. You're going to get hit with a penalty for touching this money before age 59 and a half. And you're going to have to report that money as taxable income. So you have to pay taxes on that money as well. With
Wow.
IUL, there are no age rules. So you can take your money out at 55 and still take it out tax free. So that's an additional thing you have to look at. Life does be life, and even in your 50s. So another part about it is that your 401k, if you have to use that money for a medical reason, for whatever reason, that's just money that just has to go to pay the doctors or whatever it may be. However, if you get a critical illness or chronic illness or something and you have an IUL and it's, could be hundreds of thousands inside of this policy, not even on the cash value side, but just on the death benefit side, they have living benefits. So they'd say, hey, I got, $1 million policy. I'm going to have to go fight this chronic illness and I have to go leave work for a while. Guess what? You can take that doctor's note to your insurance company and they can send you about up to 80% of your death benefit. Some companies literally actually, depending on the illness, they might give you the whole 100 and percent. So you have these other benefits on one side that aren't quite there on the other side. So you don't have living benefits with the 401k, but you do have living benefits with an IUL. So I'll talk about the differences though, because one of them is just straight cash dealing with cash on the 401k side. Most people say, I like this because it's more affordable. They're like, okay, it's just a small portion of my paycheck that's coming out. I barely miss it. My employer's matching some, fine. An IUL, depending on your age, if you're young, it's cheap, it's affordable, that's when to get it. Think of retirement when you're 25, 30. If you don't start thinking about retirement till you're 50 and you're like, darn, to have an adequate IUL that can pay me residually throughout my lifetime, I may have to fork up 500 bucks a paycheck. Depending on what my monthly
Right.
income is, I may or may not be able to afford that. So this is the reason why some people who don't learn about this to too late, they may say, "Man, this was a awesome vehicle to park my money in. I just didn't know about it in enough time." So now you have this 401k, and so those are the differences between the 401k and the IUL. There's age differences, there's tax differences, there's market participation differences, and there's access to your funds differences. But being we're kind of tying on today's subject on tax-free vehicles, it just makes sense for me to touch on the IUL and the Roth a little bit as well. So the Roth is after tax dollars. This is after you got your paycheck. They already took out your state and federal taxes or something like that. These is actual money that you already paid taxes on. You can put that into another retirement vehicle called a Roth account. And so you can call Fidelity, Charles Schwab, or one of these companies to say, hey, it takes less than 10 minutes to set up a Roth account. You can even set it up automatically to start putting money into this every paycheck or something. You can say, hey, put 100 bucks in, 50 bucks, whatever is comfortable for you. This is money that's already been taxed, and now you put it in somewhere that can also participate in the market, and you can start, and when you start to get your money out, you can also take your money out tax free as well. I saw that hand go up.
And well, yeah, just I got a question. Well, because I know, we talk and just like for the viewers, and I mean, we have resources and there's insurance for that at gmail.com and somewhere where people could reach out. I believe you're working to get your licenses to be able to do this for people, correct? So that way,
Absolutely.
if someone needs help setting up that Roth, you will be certified to say, yeah, like these are the markets we could put you in. This is how we. I mean, am I right? Is that accurate?
Yes, absolutely. Yes,
Cool.
absolutely. I'm studying to get my 6, 5, and 7. So, just want to make sure I have the credentials with the SEC and everything, and FINRA, and just make sure that while I have the information here, I want to be able to assist people
Right.
that are coming across this timeline in their life where they're like, "Hey, I want to retire," and like every day, I see people who literally have over $1 million in assets, and 75% of it is in taxable assets. They're all in
Mm,
401ks, things like that, from different employers. They've racked it up, but they're like, they just got wind. Oh my gosh, I'm retiring in 2, 3 years, and I don't want to pay this much in taxes. This is gonna hurt.
I gotta pay,
And
right.
so we say, hey, even if you took the tax hit and put it into a Roth for the next 3 years, that's going to hurt. Still, you're going to have to hit that tax. So let's be smart. Let's not take your full 700,000 out and just rip the Band-Aid off and get hit with the taxes and then start investing it in the tax-free vehicle. Let's maybe take 150,000 out for the next 2 or 3 years, because that amount falls under another taxable tax bracket.
Bracket,
Yeah, a
different
lower tax
percentage.
bracket. So over time, would you rather, let's say we took out 150, 150, 150,000 for 3 years. Would you rather get, for easy math, would you rather get taxed at, let's say, 10% on 150 every year, or get taxed on 700,000 at 32% in 3 years? Like, you're going to get taxed, but let's move half of that somewhere
Yeah,
where
yeah.
it's going to now begin to grow for you in the tax-free area. And so that way, when you do start to deduct from your taxable accounts, it won't be so much that you have to give to Uncle Sam, So
And I want to just put a disclaimer out there. Again, as I mentioned, we are like we're here to provide resources, right? Look for someone who's licensed, look for someone who specializes in this, so that way they're providing you with the accurate information. Pretty soon, Nate's gonna be that person. So, you can reach out to us at There's Insurance for That. There's Insurance for That at gmail.com. And we'll put your inquiry on our list as something to follow up with. If not, I mean, right now there are people out there who are licensed. Nate mentioned some pretty reputable companies. So if you haven't heard those companies, you go back and listen to the companies that Nate mentioned because these are licensed, reputable companies that you can reach out to for this service in particular, especially setting up your Roth and things of that nature. So I just want to
Right.
make sure that like people know, hey, look, we're not licensed in this. We're here on YouTube. We have a property. I have a property and casualty license, my life and health license. Nate has his life and health license, and his you have your accident, life, health, accident, and and
And health.
no, I'm not sure what other licenses you and your health, yes, and your health
Yeah,
license.
yeah.
So
Health, yeah.
so so I just want to make sure let the audience know that it's like, look, we're not here to give you financial advice. We're not here to give you investment advice. We're not here to give you picks on any of that. It's just this is game that has been gate kept throughout like our career. And so we're going out there to learn this information. Nate's going out there to learn this information. Really, I mean, Nate's out there in the trenches learning this information, and we just want to drop gems so that way you can do your research and you can be educated on how this money game works because
Yes.
there's a lot to know. So I just wanted
And
to make sure
so,
I said that.
yeah, I appreciate that. And that's very good to say, especially in the area of compliance. I don't want to make seem like we are technically giving you financial advice, as they say, even though it is, advice. But again, always seek your professionals, and it's licensed professionals. Um, I just say that because sometimes we have people come to the office who are do-it-yourselfers, and it's funny because some of them do very well for themselves, some do very horrible for themselves, but they still come in like, I know it all, compared to people who are like legitly in this game for 20 plus years, like who live, breathe, and eat in this space. It's just hilarious to see. But I do want to give one other golden nugget. I'm not saying necessarily do not get a 401k or anything like that. But I will tell you how to strategically operate in your 401k. Here's a tip. Only match what the employer is giving you. Anything past that point, invest elsewhere. So, for example, if you make, for easy math, let's say if you make $50,000 and the employer is matching you 10%, which they're not, but I'm saying for easy math, let's say they're matching you 10% of your income. So they say they're going to, and within a year, they're going to put $5,000 into your 401k. And, whatever you get paid every week, every other week, however systematically it's done, they're going to put $5,000 in your 401k. That does not mean, okay, great, I'm gonna put 10,000 in. Do not do that. That's not recommended to do. Only reason why is because you're putting more money into the volatile section. So it's simple to say, hey, you know what? Cool. I would have like to have 10,000. So I'm going to put my five, you put your five, if they're matching you dollar for dollar, or even if it's a percentage, just match that percentage. But you really have a little wiggle space for more, and you're, you know, depending on your age, then it might be, in your best interest to say, hey, I'm going to give you this amount, $1.25 a paycheck per week, and I'm going to put another 125 in an IUL. That way I have some market participation and some free money that's working on my behalf. And then I also have some market participation and some safeguards. So this one I have to wait till I'm 59 and a half. This one I can use whenever I need it, however I need it. This one I can contribute a certain amount, but it's going to be, at a lot of risk. The IUL, I can throw in as much as I want to and totally have no risk of losing my principal. So I would do that as a tip just to make sure you're kind of, leveling the playing field, in a good way. And then if you're 55 and older, I would not recommend the IUL. I would recommend start putting some money into a Roth. Yeah, a Roth account. Yeah, just to save on some taxes. Uncle Sam's not your favorite uncle. So that's the
Right, he's
number
not the
one.
one coming by giving you gifts. He's not,
So,
he's not the one coming by giving you gifts. Well, you heard it here, folks. I like I believe the word that came to my mind, Nate, while you were sharing is like diversification.
mm, yes.
It's like, look, diversify. Like if you're not diversified, ask ask some questions. You
Yeah.
know, reach out to us. There's insurance for that at gmail.com. Nate can help you with that IUL. Nate has access to so many different carriers and is so well versed in that realm that, he can take care
Time.
of that. And so and then eventually there's going to be that other element that he'll be able to take care of. So you might as well start somewhere. And now you're tied up with someone who's only growing and is going to make sure that your money's put in the right place. Um, yeah, 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 yeah. So, I mean, Nate, what else? I mean, man, you dropped a lot of information, a lot of great information. I'm like, people have to go back and re-listen to this.
Yeah.
But I just want to make sure, we get, just like what are the top highlights that you think are important that people leave with? Like, because you mentioned three different things. You mentioned a 401k, right? You mentioned a IUL, and you mentioned a Roth IRA.
You know what? I'm gonna say the biggest thing that I can say to anyone who's listening to this is the time is now.
Mm,
So if you are young, when I say young, 18 to 30, if you're in that wheelhouse of age, if you know, and you know you don't want to work forever, or at least you don't want to have to work forever. Like almost 100% of Americans blow every dollar they make during that threshold of time. 18 to
mm,
30, it's gone. Not $1 did you put to work to make more money for yourself over time. We're thinking 30 is old, 40 is old, 50 years old until you get to live there. You're like, crap. If I would have even put aside $25 into something systematically when I was 20, I would be sitting on, $250,000 right now. So time. Now that you know different vehicles to put park money in, you have your 401k, you have your IUL, you have your Roth, start putting money away now. And so, that's for my young viewers. And if you're there, you're in that threshold. If you're in your 30 plus range and you have, a 9 to 5, find out what your employer matches, find out what that amount is per paycheck, and only put that amount. So just give the employer what they're willing to match. It's a reason why they're only willing to match you at a certain point. So everything else, put it somewhere else where it can grow safe. Look at the IUL. If it makes sense for you, consult with us. Reach out at There's Insurance for That at Gmail. I'll be truthful with you. If it works out for you, I'll show you an illustration. We'll show you how your money will perform. And if it makes sense, go with it. If it doesn't make sense for the sake of maybe your age bracket or your time bracket, then we're going to refer you to another vehicle to put your money in. So, we're going to do right by you guys. We operate at a fiduciary standard, so we make sure it's all about your goals, what you want to accomplish, and make sure that we try our best to get you in that situation in a peaceful, non-risky way. So,
I love that. Hey,
so
you heard it here. I know Nate not only is well versed in certain worlds, but he's also well connected in other worlds, right? Where he's learning and also so I mean everything you're saying, I appreciate, the resources are out there for you, audience. Like the resources are out there, they're here. So reach out and the resources are here, and we'll be more than happy to link you in the right place so that way, it's like, I mean, Nate, I love something that stood out for me, man. Honestly, I want to make sure I highlight this is what you said earlier. Like, if you're at a certain age, this might not be right for you. Just like the integrity that it takes for someone to admit, hey, this isn't good for you. Because you get commission. Like, if they get it, you get paid, right? So you could easily be like,
yeah.
everything is great for you. Everything works. Like, it doesn't matter. Like, you can get everything. I mean, because there's people out there that are like that. It's like they're
Yeah,
just trying to get
yeah.
a sale. They're trying to get that, it doesn't matter. And so it's hard to find people with integrity. And so I just want to highlight that's one of my highlights of all this. I mean, I learned so much just, thinking about IUL, thinking about the Roth, the 401k blew my mind thinking about, oh wow, putting so much money there isn't like that's not the right move. But like the big thing that really stood out to me the most is your integrity and being like, look, like I'm gonna take a look at your case and see what makes the most sense, right? If I can help you, I am, and if I can't, I'm going to direct you in the right place where you need to go. And so
Absolutely.
that's much needed in this world, like where we are right now, just in society. And so I just want to make sure I highlight that because it says a lot about you, your character, and the information that we're trying to spread. So yeah, that was dope.
Appreciate it. Well, that's it, everybody. Thanks again for watching another episode of There's a Source for That. Make sure you stay tuned, like, comment, share, smash that subscribe button for our next episode, and we'll see you next time. Peace.
Peace.